agent, Charlie. Secretary's worse, but whatever. We'll figure it out. I can't read. It is a very interesting day to start because everything that I like to focus on is all happening at once. And that's exciting for me because it just proves the broader thesis. Brent crude continuing to rise. I stayed out of the energy trade, but once again, as we were noting, you just got to pay attention, watch the OILU. We were popping above that 20-day, coming back into that level. Looking at the OILU, looking at the Gush, Gush. Wow, can't spell once again. Now back above that 20-day moving average, that 50-day moving average, 3%. Now those names that we were talking about, like Apache, are starting to get a little bit of a pop. Might see some covering. This is where I would be trading Apache, APA, buying the $17 call, selling to the upside. Go to the 18, go to the 19, go to the 20. However you want to do it, keep the trade defined and see if energy does get a pop because of the ongoing geopolitical tensions. Questions about Iran. Doji, good morning. Steven, good morning. Randy, good morning. All right. So this is what we talked about yesterday, and boy, does this just keep being the gift that keeps on coming. This is volume weighted average price. We've talked about this before, but again, anchored to the 1 minute. We had the sell-off, and in the conversation that we had yesterday, I said the 10 o'clock to 10:30 reversal period, and the 2 o'clock algo hour, 2 o'clock to 3 o'clock, and the institutions coming in at 3. This comes down on clockwork at 10 o'clock yesterday. SPX is what you're paying attention to. Yes, there is no volume on SPX. Somebody asked a very smart question about this, but this can be done, according to my professor at Indiana, based on focusing on the ES, on the futures, on SPX options, and on things like the SPY. So we came down, we tapped that fourth deviation, and then we got this check mark. This is the type of result that is possible. Whoop, I guess they just scratched it out. I had it up on the screen, and it was beautiful. Well, I'm just going to show you that yesterday we were at $2 when we were down here. $2 on the 585 call in the SPY. So SPY, here you go. Pull that up and go to yesterday, and you'll see we have that tap. Look at the SPX, get into the fourth deviation, turn around, buy the SPY. In the money call, the 585 went from $2 to close the day at 585. Now, that's not going to happen all the time, but you're selling along the way. As I said, I buy 3 legs, sell here, and then let the third one ride. It never got below volume weighted average price for the rest of the day and concluded the day at 585. So that it did peak at around 630 yesterday, somewhere back around here. But if you just let it decay into the rest of the day, 585. Now, the thing I want to have a conversation about is it is June. It's June 3rd, the second trading day of the month. And everyone here probably has a different range of skills and knowledge when it comes to trading. I just want to lay out the basic thesis, the back to basic concept of why you need to trade in the first place. That's it. I'm not selling you anything. I'm just having a conversation with you today about the reality and the natures of the market and why the concept of buy and hold is largely insane in this environment. Again, I have spent 17 years of my time and energy on insider buying, on momentum, on liquidity. And the post-2020 reality is we are likely going to have these drawdowns probably at least once a year, right? We've seen a huge one in 2020. We had 2 big sell-offs in 2020. You might not remember the second one. We had another massive number of sell-offs in 2022 during that Fed tightening period, roughly 5 momentum shifts, all of them leading to investor capitulation. We had a few in 2023, the Silicon Valley banking crisis. We had the Nikkei crash in 2024, and we've had this recent trade collapse, right? So you're not going to have the president coming in and telling you, hey, now's a great time to buy. Probably not going to be doing that anymore. But that said, there is ample opportunity to know the importance of trading. And I know a lot of you have investment accounts. You might have IRAs, you might have 401ks, you might just be active investors yourselves. But trading is now no longer an option. You have to be trading. This is the survival skill of the post-COVID world, right? So if we go back to like post-Revolutionary War, you better have been damn good at capturing, killing, and eating your own food. Well, that's exactly where we are now because everything is so warped in terms of how the S&P 500 works and how markets work. Everything, your head is constantly on a swivel. 80 to 90% of active managers don't beat the S&P 500, right? They're making this. They're making mistakes. Trading becomes the survival skill because that's how you have to be able to offset the concerns around inflation. That's how you have to be able to offset the concerns around debasement. That's how you have to maintain and protect what is yours. So trading is a very valuable weapon, and we're going to be digging into that. Now, before we get there, just talk about momentum this morning. There's not a lot of strength in this market at the moment, and that might be surprising to some people. But as I have said, we're kind of range bound up at the under 6,000. And as we look at this and start to analyze it, the core concern that I have is the intraday momentum reading. Now, what I'm going to do right now is go to the SPY. You know that I live in this chart. I'm always focusing heavily around 20-day moving average, 50-day moving average. What's the SPY doing? Well, we come down to intraday, and that just takes us to the 1-hour chart, right? There has been some weakness and some consolidation and some chop over the last week. Right now, pretty strong. RSI elevating at 60, MFI up at 72. And ADX right here. The question is, which direction is the market going to finally move? We don't know the answer to that. That's the fun of it. My guess is going to be a little bit more to the upside. I like to see that the ADX is starting this crossover, but these have been periods where suddenly markets decide, hey, it's time to take profits and it's time to go on the roller coaster again. So right now in this environment, we look at this. Palantir has been really one of the core strong stocks. This is typically where I have seen historical tops, right? You don't have a lot of strength. That means there's not a lot of people buying. And I don't mean that they're not buying. I just mean that there's not a significant amount of people pouring cash in to drive a number of stocks up 5% a week. It's just not there. So there is weakness, again, in companies like Uber, right? Uber has been one of the strongest stocks that we have seen, and now profit taking, significant profit taking. Lyft, which we have been obviously taking aim at, is chopping around. I'm probably going to have to lift this position soon just because, right? We're sitting here hovering at this 20-day EMA, and it is just not getting under that level. It just won't break down to 14, but there is a profit in that trade. I'm going to look at that, consider lifting that lift, no pun intended. We were in the $18 put for 2 weeks from now, and it is clearly doing okay. I'd say probably 26% gain, just kind of eyeballing it. PLAM grabs SNPS. Don't know what you do. What do you do? Synopsis. Oh, okay. Wow, that's just ugly. And on our watch list this morning, PLYM. I believe that, God, I haven't traded this stock in years. Plymouth Industrial REIT. Hello. See if there's any insider buying on this. In addition, looking at GT, ASIX, and GENC. Have not seen GENC in a while either. GENC, Gencore Industries. The silver names we talked about this week. We talked about it yesterday. Silvercorp had a big pop yesterday. In addition, JOBY, which has been top of the watch list on the insider buying, 12% move this morning. Good, smart move, Mark. That's exactly what you should be doing. JOBY, nice pop this morning. And on the insider buying side, well, what is there, right? Well, Joby popped. We talked about Golub. We talked about Lionsgate. Some of this stuff's biotech. I'm not touching that. Shenandoah pops up, though. $2 million in Shenandoah. This is a telecom company. This is a very cheap company, right? Price to sales at 2, price to book under book value. It's lost some money. This is a takeover target. I've seen this a couple of times. Nice pop above that 20-day moving average. 4 insiders bought this stock. Don't know much about it, but if there is, I have to dig a little bit into the options chain. If there is a way to trade this down here, that's where my focus would be. It's the exact same thing that we did with JOBY, where we were talking about selling the 7 and buying the 6 under that support. So Shenandoah is a very cheap company, right? 0.75 book value. And if we look at who's been buying the stock, come on, let's load up. Come on, Ukraine. I know you're working. There we go. The buying is coming from 10% owners, so another 800,000 here. Energy Capital Partners, ECB, Hill City, some bids here in the last week. So a couple $1 million, and the CEO buying the stock back in March at $12. So right around this range, we're seeing Shenandoah Telecommunications. No clue what it's about. And I'm going to be talking tomorrow about unusual options activity. Unusual options activity has been, there's been chatter that insider buying activity is really what is a sign of M&A. It's not. It's largely noise in the unusual options activity world. But this is not unusual. This is just simply a variety of different companies buying up the stock. I continue to advise you, focus more on the insider buying, focus more on the 13Ds, focus more on the 10Ks, or forgive me, on the Form 4 documents, not on unusual options activity for M&A activity. It happens every now and then, and there are academic papers on the subject, but for the most part, unusual options activity is noise if it doesn't have a catalyst behind it. You need to know specifically what that catalyst is. Ghost Prince has the catalyst behind it, right? Ghost Prince has the catalyst behind it. I'm talking about people who are speculating on M&A activity. Big difference. Big difference. Pay very close attention to this. All right. So if we dig through this and we look at man versus machine, right? We look at man versus machine. Algos now dominate trading volumes. And when they collectively detect similar signals, they can cause rapid uncorrelated moves. We talked about this yesterday. Behavior impacts liquidity, impacts volatility. Recognize that certain moves can accelerate rapidly as algos trigger stop losses and force sales, and expect to prepare for the exaggerated moves. Now, the point of reminding you this is because, once again, in the world of information that we are able to obtain, right, has been chatter about what is the optimal signal. The thing that matters most in this environment, though, is trading itself. Okay? And I want you to pay very close attention to this because I've been in this research business long enough to know what's real and what's not, what's bullshit and what's not. And in this realm of you have to just buy and hold and not look at anything and do it forever, I promise you that this is the survival skill of the 21st century. Okay? Trading it is necessary. It is absolutely necessary. And if you are not active, not only are you leaving money on the table, you are leaving yourself in a position to be susceptible to the behavioral elements of finance and psychology. How often do you sell at the bottom and buy at the top? How often do you ignore technical indicators? How often do you wish you would have bought at a specific price? How often do you go back and think to yourself, damn it, I should have sold? This is fundamentally, there you go, Alex, fundamentally the battle that you are having, right? I talk about man versus machine, but the real battle is always with yourself. The S&P 500 has experienced nearly 50% declines 2 times in the last 20 years, 25 years. You'll remember the dot-com bubble. You'll remember the 2007. But what you might not remember is the massive drawdown in 2011, the 20% drop in 2015, the 20% drop in 2018, the 33% drop in 2020, the 25% drop in 2022, the multiple 7% downturns that we have seen since, and now most recently that drop from 6,100 down to 4,850 that happened in April. Okay, there have been four sigma events since 2021, right? The 2020 crisis itself was a multiple sigma event. 2022, 2023, SVB Capital, 2024 with the Nikkei, and 2025 this year. Recovery from that 2000 peak took 7 years. And for all of the chatter that's going on today, I am saying now that I fully anticipate that we are going to have at least another 8 to 10% drawdown at some point this year. And then when the liquidity cycle tops starting next year, that is where you are susceptible to long drawn down periods of selling like in 2022. Remember, the markets do not go straight down. They do not go straight down. What happened in 2022, just a very simple reminder, is we sold off. It got to the point where the algos couldn't sell to anybody, so they squeezed. They sold right back into that strength. And they did it on 2 very significant periods that aligned with massive levels of contraction in the economic index in the Chicago Federal Reserve. So once again, markets do not go straight down. They chop and they follow a staircase pattern of lower highs and lower lows. And then along the way, there are very distinctive periods where there is no buying pressure, and that leads to squeezes. This is where I first really started to focus on this. Now, as we look out into next year, there is going to be a period of time, and if you believe what Diamond is saying, that this is going to be the one that cracks the market, it could be another 5, 6, 7 years before we have a real recovery in this system. The air does have to come out at some point, and it has not, and we have been living on cheap money, cheap rent for 15 years. So the JP Morgan Guide to the Markets Q2 2024 points all this out, that, look, this is the reality of the financial system. These threats exist. And this is how different the market is. Remember, I talked about, I don't care when I hear an expert go on CNBC and he says, hey, since 1928, the S&P 500 has done X. I don't care what happened in the financial markets anytime before 1993. No more. I don't care, because there was no quantitative easing. There was no inflation targeting. There was no active Federal Reserve that was engaging in this level of activity. Now, you can go back to 1971 and I'll give you a pass. Why? Because we came off the dollar standard and we've started the liquidity cycles. But even then, 2020, post-2020 is totally different than post-2008, and post-2008 is miles from where we were in 1993 up until the crash. Now, this algorithmic trading number actually feels low to me. I have heard numbers up into the 80s, but I'm going from some data back in 2021. This is how different the market is. The average holding period for S&P New York Stock Exchange stocks has decreased from 8 years in the 1960s to less than 1 year today. It's at 6 months. So people are not only are they not buying and holding, but they're also not taking advantage of the tax structure. The S&P has saw 7 5% daily moves in 2020. That was the most since the Great Depression. We did not have a lot of 2% days after 2020. We've had a few of them this year, obviously. So these types of days correlate. Those 2% moves typically come when the S&P 500 is both under its 20-day and its 50-day moving average, the SPX, or the FNGD is above its 20 and its 50-day EMA. That's where you see that volatility. It's very rare that you wake up in the morning and the market is down 5%, 3%, 2%. It takes a big geopolitical event to drive that, or an outage, or a disaster. But those are things that you really cannot prepare for, right? Those are the black swan events. Now, here's the thing. Faber in 2007 noted that just tactical to asset allocation can reduce portfolio drawdowns by up to 50%. And the evidence is very, very clear on proactive risk management that it outperforms passive strategies, especially in volatile periods. And that's what we focus on here, right? We're focusing on how do you manage your money in an environment where a 4 sigma event is coming once every year. And on top of that, the idea that you need to actively manage your money. You know, do I have enough cash? Am I buying at the bottom in April 8th? Well, then you should have been, because again, we've shown the pattern multiple times. Break into negative momentum on February 21st of this year. No buying pressure at all on March 13th. Squeeze that we predicted. Then all of a sudden they sold right back into that pressure. Bottoms out, zero buying pressure, massive insider buying, break the 20-day, market's off to the races. This has happened so many times in the last 5 years that it's getting predictable. And yeah, it might not take sometimes, right? This was a place where a lot of people were trying to buy. The reality is you want to look for the policy shift and you want to look for that insider buying spike. This is all active management. This is all active strategy. And Arnott in 2020 talked about, the performance of active risk management. So proactive risk management strategies are crucial for navigating markets today. From 2000 to 2023, the average equity fund investor earned 5.1%, underperforming the S&P 500's 7% annual average. And I know for a fact, going into 2023, when we were up 20-some percent, that very few people beat the market that year, because there was behavioral bias, there was a lot of downside predictions, there was a very small understanding of how liquidity and momentum operated. Panic selling happens. It contributes to underperformance. And I know that you probably have engaged in panic selling at some point. We all have done it. The core thing, though, is to start to recognize and understand that panic period, that volatility, that is your window to make very significant gains. You have to look at that. You have to look at the blood in the water and say, I'm diving into that. You're not running away to it. You have to learn to run at fire. I'm going to use so many fire metaphors and disaster metaphors. Look, at the end of the day, you want to be the person who has plenty of cash available to take advantage of the situation, to actively trade it, and to utilize patterns that are very, very obvious that we have seen our entire lives over and over again. So, yes, it's very difficult to have the liquidity to take advantage. But as I've noted, it's if you're actively managing and you're actively focusing and you're using things like momentum and understanding that, hey, this might be something significant when we break the 20 and the 50 on the FNGD. Maybe I have to lick some wounds and take some losses, but that's going to give me the liquidity and the cash that I need to be able to take advantage of this situation. It actually is not that difficult to know that just simply using certain technicals to have that cash available. Or you invest in certain assets like certain closed-end funds that will kick off cash, that are in the bond market, that are highly liquid, and you're going to be able to turn around, convert that to capital, and then take advantage. You don't have to just have cash. You can have cash-like instruments that are going to be able to generate some returns. In addition, like this is why there's so much cash in the money market, right? Everybody's getting paid 4.5%, 4%, and they're just waiting for the opportunity. I have a lot of cash in the money markets. All right. So in 2024, CBOE's options exchange traded a total 3.8 billion contracts. That's 15 million a day. This is from CBOE. 80 to 90% of that came from institutions that were using derivatives for hedging or income. So again, I do say that you have to have a catalyst, right, to really recognize what is unique and unusual. If it's not going to be people speculating on M&A. So a good example of that goes back to when I first joined here, and I was talking to Blake, and he was on FCX, right? He was on FCX. And there was a lot of unusual activity there. Why? Because of the geopolitical tensions. There was that pure catalyst. There was that knowledge. It wasn't buying FCX because someone was speculating that the Chinese were going to buy the company. Source is CBOE. So Greenwich Associates noting 80 to 90% of that. So how options improve returns and reduce risk. Hedging with protective puts can significantly reduce portfolio drawdowns during downturns. Selling covered calls can enhance returns in flat or moderately rising markets by 2.2 to 4% annually. This comes from the Hathaway study and the Callan study in 23. The NASDAQ dropped by 33% in 2022. And if you had just allocated a 5% portfolio to QQQ puts or rehedged quarterly, it could have reduced those losses to 18%. So if you are a long-term buyer and holder, or you are actively managing, a number of stocks. I had a friend who sold a big portion of his Apple stock when our momentum reading went negative in February. Now that's one way to do it. And he bought the stock back right in early April and did pretty darn good on it. But could have hedged it, could have managed it actively, could have sold calls on top of it. There's a lot of different ways to do this. So this is about discipline as well. So options require predefined risk reward and they promote discipline. And there's plenty of academic information on this. Structured options use reduces emotional decision making. And that's one of the key things. We want to get away from having these knee-jerk reactions to trades. I have not talked about Google yet. I have not, but Google is proving the point of this, right? So when we talked about, the QQQQ, I will talk about Google real quick. Somebody said today, well, Google could fall another 20% in the event that, there's a judicial ruling. The reality is Google is like every other stock in the stock market. It's impacted by liquidity. It's impacted by emotion. And when you trade around the FNGD, which I've noted right here, the FNGD, when the FNGD breaks under that or over that 20 and the 50, well, good things happen to people who are shorting stocks like Google, because Google broke its EMA, broke its 50, marked on February 10th. And by the time that things had really gotten ugly in this market, here is your real drawdown. 184 took you down to 142. So for all those people out there saying it can fall another 25% because of black swans, well, first off, it's not a black swan if you're actively saying, well, if they've had this judicial ruling, that's going to create a black swan sell-up. That's not what a black swan is. That's more of a gray swan, or it's even a white swan because there's a catalyst behind it. But that said, here's the drawdown. If you want to know when to get out of Google, it's going to be right here. If you're worried about that, use this as the stop or hedge accordingly against it. That's just somebody also trying to shake the bag out. They're trying to get people to sell to them. Google for the long term is great stock, but it's going to be susceptible, like every other FANG stock is, to significant drawdowns in an environment where it is so heavily owned by ETFs and passive investors and panicking retail investors. It is a communication stock. It is a momentum stock. It is a interesting long-term buy and hold, but for the most part, it trades and tracks the S&P 500 like everything else does, right? It had huge drawdowns in 2020, nothing that it did wrong. That is all tied to the broader macroeconomic situation involving liquidity, interest rates, exchange rates, and so forth. So if you're actively trading it, you have seen the big momentum move that it had coming off of September, 158 all the way up to 203, and then breaking down, negative momentum took us all the way back down to 140. What do you see here? What do you see in these charts? What seems to be the common thing, right? The 20-day EMA, 50-day EMA. Bad things happen under both. Good things happen over both. It's all momentum. And it takes a lot of cash and a lot of capital and a lot of inflows to keep a stock consistently above its 20-day EMA. It takes a lot of money. So, once again, I don't see that being a black swan But I would, as we move around those 20-day moving averages, that's where we would be focusing on managing that risk. Algorithmic trading, it says 37. I've heard up to 80 before. But again, this was the number that came from Trade News 2023. Options allow investors to adapt to volatility and uncertainty in a machine-driven market, 100%. And we saw that again yesterday with the algos in the SPY and the SPX. So option spreads, collars, iron condors, they do reduce risk and generate income. Now, these all sound very complex. Collars, iron condors. Some of you may have never even heard those terms before. That's okay. Understand that this is a guide, this is a system you're going to get to ultimately learning these types of strategies. The reality is that without these types of tools, you're not going to be able to hedge overnight, particularly event-driven or with tail risks. We just said it's very rare that you wake up in the morning and there's a drastic downturn. But in the morning, when you're pre-market, most retail investors have no way to get out of positions. And that's why you see panic selling in the first 15 minutes when something is wrong. There's very little opportunity to generate income from volatility. No way to stay invested with less risk. But if you start with things like covered calls or protected puts or cash secured puts, this is the easy way to start, right? So if you own 100 shares of Google and you don't want to let go of your Google, and you're not going to be like me where you're going to be actively jumping in and out of the stocks. You're going to own it for the long term. You're going to take advantage of your tax benefits. Good, go for that. But recognize that when you get to these levels, right, this is where you need to be selling calls. Go up 10%, 25%, go out a month. Generate income while all of this nonsense is going on. And then buy it back. And if the stock remains under these levels, keep selling to the upside, but make sure that you're not taking a loss on your total position. Focus on where you can generate income. Overall, and we look at this, right? We look at the current situation. Most people don't take advantage of these things. They don't want to take the time to learn it. We have built a massive platform of education. It's all available at your fingertips. Go in, look through everything that's on the left side of your member screen, and you're going to see just the sheer amount of content from the most advanced trades in the world to the very basics, right? Buying calls, selling calls. Most investors just buy calls. That's not the purpose of this. There's so many other elements involved that it's very important. And as the financial landscape keeps evolving over time, you have to adapt to it. It's going to become more financialized. There's going to be more volatility. There's going to be more zero-date options trading. And all of these things will evolve. Be very aware, ask questions. If there's a new strategy or a new thing that you're seeing out there, ask questions about it. And say, look, nothing is easy in this world. Nothing is easy in trading. There's no magic box. A lot of people will try to make this sound like all you got to do is just do this one thing a day and you'll be able to generate 50. It's not the world. This takes some work. But the reality is once you master it, and you can and you will see much better results. You're going to sleep better at night. You're going to have a better understanding of what and how this market operates. And then you're going to have the tools to your advantage to take advantage, understand how to scalp, understand how to identify what is a real option that looks unusual versus what is bullshit. What are the things that you need to do in order to survive? I'm going to use that term. It is a heavy term, but it is reality because most people don't beat the market. Most people get their heads kicked in. Most people are losing money to debasement. Most people are concerned about inflation, and they don't recognize that you have this machine in front of you that can deliver very significant gains and significant returns if you learn how to manage your risk, understand your risk tolerance, and also take advantage of what the market is giving you. People say all the time, oh, options are too risky. They're too complex. If you use them the right way, they can reduce not increase portfolio risk. Education and position sizing are the key. These are the things we talk about every day. Options are just for speculation. No, they're not. Options are essential tools for hedging and generating income, not for betting on direction. Long-term investors don't need options. Yes, you do. Yes, you do. Options allow long-term investors to protect against downturns, and they can generate extra returns even in flat markets. And if you don't believe me, this is your study guide. JP Morgan Guide to the Markets, CBOE, Greenwich Associates, CFA Institute, Dalbar, Enbur, Cowen, BlackRock. I've read all this crap, right? I've read it all. And I can tell you, this is your PhD wrapped up in, I called it crap. I shouldn't have said that. But the point is, right? Cal, Faber, Bolton, Barber. Read this stuff. And if you don't want to read it, get a PDF of it, put it into ChatGPT and say, hey, ChatGPT, explain 80, give me the 80-20 on this. And it'll and also explain it to me like I'm a golden retriever. And it will do that. We're going to talk about AI in the coming weeks, the types of tools that exist for traders. If you're not using ChatGPT, if you're not using Claude, if you've never heard of it or even understand how it works, keep in mind, this is one of the greatest tools in the history of being a trader and being a researcher. And some of the things that you'll be able to do with this, which is great, you could take that JP Morgan Guide to the Markets, you could plug it into ChatGPT, and you could say, I have zero idea what any of this means. Explain it to me as if I was trying to understand baseball. And it will explain to you the risk of options, the opportunities with options, but it'll put it into baseball terminology. If you want it in chess, it'll explain it in chess. The point is, you have more tools than you've ever had before, more information at your fingertips than you've ever had before. All you have to do is simplify it for yourself, take advantage of what's in front of you, and then have the conviction to hit the buy button and make the trade. I hope you guys have a wonderful day. The Golden Retrievers line is a reference to the movie Margin Call, if you haven't seen it. Key scene says, explain to me the financial crisis blowing up at the firm as if I were a golden retriever. It's not brains that got me here. It is 9:22. Don's coming in right now. 3TW once again. I think we're still doing name your own price. And we will be back later today. We got a lot going on this week. I hope you guys have a wonderful day. And I'm going to check out of here. Don, have a good one. Talk to you guys soon.